Hi, this is Bennett Tchaikovsky, and welcome to using T accounts to determine the cost of goods manufactured. Really quickly, the textbook reference in this is something that is offered by Open Educational Resources. The textbook is Managerial Accounting, was adapted by the Saylor Foundation under Creative Commons Attribution, which can be found here. And I'm using Open Educational Resources to essentially give you, so I can make this video public. I've found that dealing with publishers, they are extremely reticent to give me any kind of permission to use their materials. So what I'm doing is I'm kind of modifying some of the questions that they have out there for helping you better understand managerial accounting. So really quickly, the disclaimers, the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyrighted by 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and the links to the presentation on an unmodified basis. If you do modify the presentation in any way, please email me prior to doing so at bennett1812@gmail.com to discuss. And I do not claim any copyright whatsoever into any companies or organizations mentioned in this presentation. Rather, the other parties are the owner of their own respective copyrights. So right here, this is kind of as I'm looking at these different T accounts, and if you want to know why I love T accounts, I encourage you to take a look at my prior financial accounting videos. It just really helps me better understand and visualize in terms of what's going on. So when we're looking at inventory for a manufacturer, it's going to be different than what we were doing previously in our financial accounting inventory chapters. So when we were dealing with financial accounting, as far as, when we were looking at inventory, typically what we would do is we would go through and we would see something along the lines of, oh, I'm selling a product right here. When I make a product sale, say on account, I'm going to debit AR, I'm going to credit sales, and then I'm going to be debiting cost of goods sold, and I'm going to be crediting my inventory. And if you kind of think about it intuitively, this cost of goods sold or COGS, okay, and finished goods inventory, which is the same as inventory, what we were really doing is we were going through here. I was debiting cost of goods sold and I was crediting inventory. When we look at beyond in terms of being as far as like being a manufacturer goes, what we have to kind of go through and think about is that, well, the inventory for a manufacturer is going to work a little bit differently. And how is inventory going to be working differently for a manufacturer? Well, the way inventory is going to be working differently for a manufacturer is that right here, you've got essentially these accounts right here, like raw materials inventory, work in process inventory, and then you're going to have finished goods inventory. And so it's important to kind of remember or to kind of remind ourselves of is that when we're dealing with a manufacturer, they're not a retailer. This over here is for a retailer. Now in managerial accounting or in cost accounting, we're really focused more on the manufacturing side. So our inventory is going to be looking a little bit different. And just to kind of show you an example of that difference is like, let's take a look at the financial statements for Coca-Cola. So I'm here with the financial statements here for the Coca-Cola Company. And as I go down here, and again, I have videos. If you want to look at how I went through and did this, you can go on to my website or go onto my channel and see how to look up publicly traded companies. If I go over here to my inventory, right over here, my inventories for the Coca-Cola Company. Remember, Coca-Cola is kind of like a manufacturer just because, you know, that's what they do. They make beverages and other things. So if we look over here at the Coca-Cola Company, they have about 3.4 billion in terms of inventories. And let's take a look at what makes up that inventory amount. The way we're going to do that is we're going to go take a look at the footnotes to the financial statements. Those footnotes are going to come down here behind all of these other, the footnotes are really giving us additional detail about what's on the balance sheet or what is on the income statement. And if I come down here, let's just keep going. Inventories, note 5. Inventories consist primarily of raw materials and packaging, which includes ingredients and supplies, and finished goods, which include the concentrates and syrups in our concentrate operations and our finished beverages and our finished product operations. Inventories are valued here. So what we're kind of seeing here is that, well, what goes into our inventories for Coca-Cola? So because Coca-Cola is a manufacturer, it's going to be different than, say, the inventory that's being carried by Walmart, right? So Walmart, their inventory is, they're not really making their own inventory or their own items, not that I'm really aware of. So they're not going to have that manufacturing element. Rather, they're selling the items of other companies. So when we're looking over here at, you know, for these manufacturing companies, we're really going to be concerned with 3 different types of inventory accounts, which are going to be raw materials, work in process, and finished goods inventory. These right over here are going to be ultimately what is going to be going to our balance sheet. So similar to Coca-Cola, we might just see, well, we would see inventory at 3.4 billion, but really what makes up that inventory are going to be these different items. Now, I don't know what other is. That could be work in process. I just don't know. But it's important for this concept here in terms of how this kind of works. Now, what happens here is during the manufacturing, the cycle or the process, what's going to be happening is that, well, if we're turning on the machines and we're going through and starting production, what we're going to be seeing happen is that we're going to take raw materials, and the way this is going to be kind of working is we're going to have our beginning raw materials inventory plus our purchases. Okay, and this is going to be giving us something, what we would be calling goods available for sale or inventory available for sale. But then what we're going to do is we're going to basically deduct or basically take out, this is raw materials into production. Okay, so we're going to take this out here, and what's going to happen is that this amount right over here is what we're going to be calling our direct materials. Okay, so when we're dealing with a manufacturer, okay, and they're going to have 3 different inventory accounts, and this is really kind of the way that we're going to be looking at inventory for a manufacturer. Again, this is going to be different than the traditional retailer, which would just be looking at these 2 accounts. We're now saying, okay, we've got a few steps before we get over here into our finished goods inventory. So my beginning raw materials inventory plus my purchases less my raw materials into production is basically going to be giving me over here as my ending raw materials inventory. And if I were to write this as an equation, if I said A, B, I call this C, this D is going to be equal to A plus B minus C, okay? So my beginning plus my purchases gives me gas or goods available for sale, or in this case is raw materials available for use, less what I put into production gives me my ending raw materials inventory. So this is a very, very important part of the process. So when I'm looking at work in process inventory, okay, so I know that I'm going to be adding in direct materials, which is what I'm going to need to do to ultimately get to finished goods. Some of you might be saying, or you're working on a problem that might have something called indirect materials. I'm going to be looking at that on a future video, which is really my job order costing video. So that's where you want to go take a look at that one. But for right now, we're going to stay a little bit more focused in terms of the raw materials into production. Well, if I look at my work in process inventory account, I know that right over here, it's not just going to be direct materials, but what is work in process? Well, it's items that we started but have not yet been completed. So over here, we're going to have our beginning work in process, or a beginning WIP. And what is WIP? Right over here, it's not cool, WIP, or Stewie's WIP. My dad humor coming out, or inappropriate dad humor. My kids never watch Family Guy. Okay. So I got my beginning work in process, and then I have my direct materials. What else goes into work in process? Well, there's something over here that is called factory payroll. So I have my total factory payroll. And what exactly is factory payroll? It is payroll that relates to the production process. So I'm going to have a total amount over here for factory payroll. And out of factory payroll is going to be coming two items. Okay. So factory payroll, you're going to see over here, direct labor. Okay. So this is going to be my direct labor. And the direct labor is labor that's directly going towards the production process. I can trace it directly to that manufacturer. Somebody who's doing assembly on a particular type of product. My next type of factory payroll is going to be indirect labor. And indirect labor is labor it's happening at the factory, but I cannot directly attribute it to one particular product. So for example, if I have someone who's working directly on Monster Energy drinks, which is something that is owned by the Coca-Cola Company, and they're directly working on that particular product, hey, that's great. I'm going to be putting that directly into work in process. However, if I have somebody that's overseeing not only Monster Energy, but it's like Coke Orange or Coke Orange Vanilla, or Coke Zero Orange Vanilla, or some other kind of flavored drink that's going to rot my teeth out, just kidding. In that case right there, right, this is where if I can't directly attribute it to one particular product, what I'm going to end up doing is right over here is I'm going to put this into my factory overhead. So my indirect labor is going to come down here. Now, when I look at this factory payroll, very, very important. Okay, so what's remaining so these are going to be the three items right here that are going to be going to my balance sheet. However, factory payroll needs to be zeroed out at the end of the period. It cannot have any value, so it has to be zeroed out. Similarly, when I look at factory overhead is going to have an ending zero balance. So what goes into factory overhead? Well, have indirect labor. It could be factory equipment, depreciation, could also be what is factory supplies. Okay, what's another good one? Factory supplies, let's see here, factory rent. Okay, so if you see something with the word factory, it's going to go into factory overhead. And also for those of you who have jumped ahead to a future chapter, this would also include indirect materials, similar to indirect labor. So as we go through and do this, these are basically, we got our total factory overhead over here. So what we would end up doing is we would basically total up this factory overhead over here. We would go through and add these items up. Then over here, to make this account go to zero, what I would need to do is to say, okay, this is going to go to work in process. And this is going to come up over here from my factory overhead. Okay. So right over here is my, basically, this is coming over here to my factory overhead. So again, as I'm going through and doing this, and we're going to work on a sample in just a little bit, this is where it has to basically go. So this is going to have to be zeroed out at the end of the day. My factory payroll is going to have to be zeroed out at the end of the day. And then these are going up here over to my work in process inventory. So when I get to my work in process inventory, I have my beginning work in process plus direct materials plus direct labor plus my factory overhead. And what's going to happen here? Well, during the period, I'm going to be completing items. And this is when I complete this, this is what we're calling our cost of goods manufactured. Okay, this is what we call the cost of goods manufactured. I'm going to have a beginning amount of my work in process, plus my direct materials, plus my direct labor, plus my factory overhead, minus what I completed. And this is going to give me my ending work in process. So this is, again, going to be another thing we'll be saying here, A, B, C, D. And we'll call this letter E. So we'll see here that F is going to be equal to A plus B plus C plus D minus E is going to give me my ending work in process. So where does the cost of goods manufactured go? So this is going to be coming over here to my finished goods inventory. Okay. So when I get to finished goods inventory now, this is what's going to look like when we were doing retail inventory methods, which is going to be my beginning FGI. So right over here, my beginning finished goods inventory plus my cost of goods manufactured, or plus, this is kind of like another way of saying purchases, minus my cost of goods sold is going to give me my ending FGI, or my ending inventory. My ending finished goods inventory is going to be equal to my beginning finished goods inventory plus my cost of goods manufactured minus my ending finished goods inventory. Now, some of you may have book solutions in front of you, and I'm just going to pause something really quickly so we can take a look at what that looks like. So right here, thanks to the power of Google, thank you, Google. Right over here, you're saying, oh, this is a sample of the cost of goods manufactured. You have beginning raw materials plus purchases, gives you raw materials available, less ending, gives you raw materials used in production. If you look at this right over here in terms of what we've done here, so my beginning over here, if I look at my beginning plus my purchases, and then over here plus my purchases, this gives me raw materials available less. My ending raw materials inventory is getting me my raw materials that I use in production. So essentially what we're doing here on the T accounts is essentially another way of showing this right over here. So the three parts that are going into my cost, or basically essentially going into the cost of goods, determining the cost of goods manufactured, is going to be right over here. It's going to be my direct materials used in production, which is right over here, plus my direct labor, which is right here, plus my factory overhead. And here, if you look at this, indirect materials, indirect labor, factory supplies, factory depreciation, factory insurance, there you go. So right over here, my total manufacturing costs, which is going to be $595, in this case, $405, $200, plus the beginning inventory, right? This is giving me my total, essentially it's my total manufacturing cost for the period. I then add my beginning work in process, which basically gives me everything that's there, less my ending work in process inventory tells me my cost of goods manufactured. So what I'm trying to do by looking at it with T accounts right here is that, hey, how can we make this a little bit more visual and a little bit easier for us to do? And the importance of doing something like this is going to become extremely evident when you get to job order costing. When we get to job order costing, what we're going to find is, well, we're going to have some nuances here with this factory overhead where a T account is going to come in huge, huge help. So that is the end of part 1 of this video. I'm going to return back shortly, and then we're going to start up an actual question. And I want to thank you for watching, and do not forget to like and subscribe. Thanks so much.